You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the Options Insider Radio Network. For you, the busy financial advisor or asset manager, maybe you're considering taking a dive into those options waters. Maybe also you're out there looking for a financial advisor. Maybe you wonder what skills they should bring to the table on the options front. Either way, we've got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network, reminding you, if you enjoy what we do, not just for this program, but for the entire network out there, make sure you leave those reviews on your platform of choice so new folks can continue to discover our programming in these troubled times. More folks out there surfing the online audio content landscape than pretty much ever before. They need a place to go. They need a lighthouse in these troubled waters and troubled times. So, of course, if you like what you hear, leave those reviews. Keep those new folks continuing to discover the program out there. And, of course, keep those questions coming, too. We do love to hear from you guys. And let's see who we're hearing from on the program today. First, let's go off. It's snowing here in the Chicago downtown area, which is kind of surprising to me here in October. So let's start off somewhere that doesn't even know what the heck snow is. Yes, we're going all the way out to sunny and warm Puerto Rico. We are joined once again by Mr. Chris Hausman, the portfolio manager and the overall director of risk over there at SWAN Global Investments. Mr. Risk Director, welcome back to the program. How does it feel to be 85 and sunny these days, sir?
Well, it's one less thing that I have to manage, so I don't worry about snow, so that is a good thing. But regardless, good to be back on with you guys.
I hear snow shovels pretty cheap at the world's largest Costco near you, sir.
Very cheap. We use them to make sandbags when the canes come.
Yeah, that's true. You have other uses for them down there. And also joining us, he's supposed to get the snow this time of year, not us. We're moving that dial all the way back up to New Hampshire, where we are joined once again by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the keepers of all that cool earnings data you guys love so much. Matt, welcome back to the program. It's supposed to be you guys snowing up there, not us, sir.
Nature's putting on a show here. The leaves are turning. It's bright red and oranges outside. It's beautiful out here, Mark.
I do miss New England in the fall. One thing we are kind of lacking here in downtown Chicago is the foliage. But we're not lacking is some great content. Let's head right on into The Buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. This is usually the portion of the show we break down the hot topics, things you may have missed in the world of derivatives. But these days, during the COVID era, the beginning of The Buzz in particular has taken on a little bit of a different bent. Maybe we need to come up with some new VO to segment this part off, because it is its own beast. These are crazy, troubled, turbulent, volatile times out there in the market. Every time we do this show, a number of crazy and unprecedented events have occurred in the intervening month. So we like to start The Buzz these days by breaking all that down. In particular now, of course, we find ourselves coming up on, by the time we have our next show, we will know who the next president of the United States is. So a big election looming in the near future. A lot to unpack. We've seen tremendous amount of volatility in the markets again, then some easing of that volatility, then just in very recent sessions, just yesterday, a very large sell-off, again, reminding us that not all of the unknowns are out there, and they're not all behind us, certainly, as well. So a lot to unpack in the current market, the current volatility environment. Let's go in the order of the way we came. Let's start with the Director of Risk. Mr. Risk Director, sir, what's been lighting up your tape and catching your eye over the course of these crazy markets since our last show, sir?
Yeah, I mean, technically, the SPX is having a battle with the 50-day moving average. That's around 34.10 right now. I don't think things are oversold just quite yet, and then probably would like to see a test of that 32-quarter area we had a few weeks ago and see if that holds a support for the bullish case. Other than that, we've just been range-bound here, 3,200, 3,600. And I do think a good break in either direction could lead us up to 4,000 on the upside or all the way down to 2,800. So we're kind of in a wait-and-see game right now. Vol-wise, we're still looking at backwardation state here with the SPX. And I do think and I do anticipate vol is going to come in a good 4 or 5 handles at least, once we get some of these unknowns out of the way, like you said. And I don't be surprised if we're in that vol down, spot down type of environment. I think it's going to take a real break to the downside of that 3,200 level to keep these vol levels elevated. And as far as cross asset vol, this has been for a while now where SPX vol is rich to emerging markets. So again, I'm keeping an eye on that and see how that's going to unwind after the election.
That's a good point about the indices and the vol products moving in lockstep. We have had a lot of questions about that lately because we have seen that rearing its ugly head a lot these days where usually of late it's been them moving up together, but you're right, we are at a little bit of juicier levels right now, so it is certainly possible for the indexes to drop a bit and for vol to come in a little bit as well. Remember, at the end of the day, listeners, the volatility calculation is fairly straightforward. All that matters is how much you're moving. People always think vol is just downside movement, but movement to the upside, it's also movement. It also works into that calculation. So we might be in that environment, particularly with this big event looming on the horizon, where we might see more of that, more of the indices and the vol products moving in lockstep, which certainly means you're in for some interesting times out there in the marketplace. Mr. Matt, same question for you, sir. Obviously, a lot has occurred since our last program. A lot is looming on the horizon. We'll get to that in a second as well. What has lit up your tape and caught your eye over the course of the past month, sir?
Yeah, firstly, we're coming into earnings. Low implied earnings expectations this season after getting burned last season. The buyers are not as aggressive. We'll talk about that a little bit later, I hope. And in the broader markets, yeah, it's we measure contango and its opposing side backwardation, which, as Chris mentioned, we are in right now. I always also look at forward relationships, and they're getting a bit out of whack. I don't like the market all too much right now. According to our ORATS indicators here that we're looking at. So I think there's some turbulent times coming. Obviously, we have an election. We have the remains of the election in the next months after that. But there's a lot of trepidation out there. I actually think more that the election's a little bit of a smokescreen for other things that may happen, Fed-related, earnings-related, et cetera. So it's going to be some interesting times that we are going to be living in, Mark.
Certainly interesting times. And listeners, pay attention to that. Matt has proved eerily prophetic. Some may call him the Oracle of New Hampshire out there. I call him the sharp-dressed man of New Hampshire. Mr. Matt, did you happen to see? Was that you? Were we correct? Did we find the right guy in that freeze frame, sir?
Oh, I did not see that. I didn't get wind of the freeze frame, and
yes.
And I have to make another statement here. For my real appearance, my cameo was in the Side Out movie. So you could really get some good screenshots and hold them for ransom there.
Side Out, I don't know that one. Look at all these side appearances of Mr. Oratz. We'll have to keep our IMDb scouts on overdrive here to find all of Matt's credits and get them printed out here. But yeah, if you missed it, listeners, Matt hinted on one of our other programs this month that he actually was in the background of ZZ Top's infamous Sharp Dressed Man video. So we think we found him and tweeted it out and highlighted it for you. So follow us over there at Options. You could see Matt in all of his ZZ Top glory. What was in its glory, and it kind of dominated a lot of our discussions starting very early in the year, going all the way back to January. I think it was you, Matt, who said, I think this election bump they're pricing into the volatility space back in January and February seemed like it might be a little bit overdone. Maybe we need to sell that. Of course, February rolled around, then March rolled around, and other priorities intervened, and the election bump seemed like it was a bit distant, and then, of course, all the madness unfolded, and other vol got ejected into the marketplace. And yet we saw that bid, that bump, that juice around the election time frame remain fairly persistent. It was pretty aggressive, and what was a little bit disturbing to a lot of people as well is that it was not really isolated to the election itself. It was through the election and indeed beyond, into the rest of November, into December, and even January. In fact, we broke it down on our last program, listeners, which is just a month ago, showing how much juice they were pricing in through the election at that time. Of course, obviously pricing in a bit of a contentious and contested election all the way through, perhaps even to Inauguration Day. On our last show, which was about exactly a month ago, that October VIX futures was the front future at the time and has now rolled off the board. But at the time, that had about a 4-point premium to the cash. So they're pricing in some hefty vol there. The no future, which kind of encompasses all the madness, that had a 5.2-point premium to the cash VIX index. December had about a 3.5-point premium, and the Jan future had about a 2.6 point. And those had all come off a little bit on that last show. They were pricing even more juice in the weeks leading up. I think for a while there, Jan was even at 3+ or 4 points. So they were pricing in a lot of vol for a while there. And then most recent numbers we just crunched these numbers on Friday for our volatility views programs. Obviously, these don't include the big sell-off from yesterday, but I think you'll get the gist of it out here. Coming into the VolView show on Friday, obviously the OCC future off the board, so November is now the front month contract. That is pretty much even with the cash. At least it was at the time that we crunched these numbers a few days ago. It was about 0.75 of a point distant, so not a lot going on. Obviously the cash is a little bit, shall we say, juicy right now as well, so that could kind of obscure this a little bit, but still, seeing what they're pricing in out there is a little bit surprising. The D's future was about 3.5 point premium to the cash on our last show. Right now it's about a third of a point. So it's come in, it's pretty much a tenth of what it was just last show. And the Jan future was pretty much almost in line with the cash. It was about a third of a point above the cash. Last show was about 2.6 points. So pretty much all of that juice that they were pricing in through the election and beyond has pretty much been squeezed out. Now, that, of course, could argue that maybe the market thinks there is going to be an outcome on election night. They're leaning in favor of one candidate or the other, at least in terms of how the polls are going. Now, of course, we have seen similar events like this unfold in the past where the market was pricing in one outcome, and then we saw a very different outcome actually unfold. The 2016 election comes to mind, of course, because most of the quote-unquote smart money was on Hillary leading into that. And then going back even to Brexit, we saw there were some polls right before Brexit, the vote was cast, where it seemed like it was not going to happen, and the market really crushed that volatility. And, of course, you all know what happened in Brexit. So the question I have now for both of you gentlemen is, A, what do you think of how aggressively they've come for this volatility, not just during the election itself, but beyond all the way through to January? And B, do you think maybe we got a little bit of a Brexit scenario cooking here where perhaps they're coming for it a little bit too early? Mr. Director of Risk, we'll start with you, sir.
Well, I just wanted to say that Ocnov D's time flight paid out nicely if you held that all the way to October expiration. And I've been saying on this show, when I think we all agree together, is that something had to give at some point. Now, I didn't think it was going to give this much before the elections. Is it a little overdone? I don't know. Looking at the VIX right now to 33, I think that there's still some fear to the downside, and there's going to be some unknown that we don't know about, kind of like what Matt alluded to. So, I do anticipate that there's going to be some vol, with the pickup recently in vol, I do think there's going to be at least 4 or 5 vol points that come out of this unless something else happens around here. I just don't think that we can sustain a 30 plus VIX without any movement, because the shorter term realized volatility on a 5 and a 10 day just isn't supporting it right now. So there's just a lot of, I think there's positioning going on. If you're a premium seller, you're probably sitting on the sidelines right now and then waiting for the event to happen. And that's why you're seeing the elevated volatility right now.
Oh, realized volatility. What fun is that? What fun is basic math when you're calculating volatility out there? Matt, same question for you, sir. I'm kind of curious. Obviously, they've come for this vol fairly aggressively. What are your thoughts on A, how aggressively they've come for that, and B, maybe what they're pricing in going forward heading into the election, sir?
Yeah, the weirdest thing that we've seen over the last few months is the way out of the money calls and that SoftBank rumor where they were the NASDAQ whale. I think they admitted to being a dolphin. But I think if you add in the Robin Hooders swimming with the dolphin, it looks like a whale. And so they really bid up those small calls. I think that dragged up the NASDAQ, a lot of this gamma that they talk about. A lot of us were ex-market makers, and you've had these positions on where you're short some strikes and long some strikes against it. But when the market went to these way out of the money strikes that you were very short, then it started getting very interesting as a market maker. You had to buy when the market was going up and sell when the market's going down. And these huge positions that they have on right now is exacerbating, I think, this movement that's in there, exacerbating the volatility of the market and the implied volatility, VIX. We've seen that call relationship come down a bit lately, a little bit more interest in the puts, but like I said earlier, there's a lot of volatility baked into this market that is more than the election, more than even if the election's contested, I believe. So it just it feels, how you get those market maker feelings in the back of your neck. Something feels odd to me right now, Mark.
I've been feeling that for most of 2020. Maybe I have COVID, Matt. I don't know. But something is certainly tingling in all sorts of weird places out there right now. It has been for most of the year. But you're right. this volatility, this market is more than just the election. And let's prove it right now. Let's crunch some of the numbers, because maybe you've been living under a rock. Maybe you just weren't paying attention, but it's back, listeners, and it is back with a vengeance. Yes, I'm talking about your favorite or perhaps least favorite part of the year. It's earnings season. Even if you don't like it, you like to see the data on it. We've got it for you, courtesy of Matt and his team over there at ORATS, crunching out the earnings move results, and earnings season. That's a crucial one these days. The earnings season reports as well. You guys know where to get all of them, not just during the show, but throughout the week, every week out there. Just go to theoptionsinsider.com. Click on that options news and articles tab, top right corner, to begin your journey to the dark side. Just be forewarned. There's a lot of data there. There's a lot of tickers. You're gonna get sucked down that rabbit hole. You're gonna be there for a while. If you're like me, you can look at these reports for quite some time. So Matt, we just came off what I believe you refer to as the bloodiest season you've ever seen for options volatility and indeed premium buyers. We've only got a few names under our belt, but this is a big week so far for this season. So A, if you have any final thoughts on last season, I know you revised it a little bit towards the end, so maybe it wasn't as terrible as we initially thought. And then B, what are your thoughts on what we're seeing and perhaps what you're expecting for this season, sir?
Yeah, it was very bad last season, Mark. And, I think in the aftermath, we were having some good Twitter conversations. And, when you have Robinhood, when you have SoftBank types, when you have a lot of other than professionals in the market not really looking at earnings, it tends not to move so much when stocks are moving 3%, 4%, 5% before earnings. You're not going to get that huge bump during earnings. Something else is driving them. So that's what I've kind of come to blame that bad earnings performance on. But as I mentioned at the top of the show, this season they've really brought down the implied earnings move. And when I was in the NASDAQ hot seat, I wrote about it, and then we posted a blog on yours and the NASDAQ's blog, and it got some good traction. And so what we were showing was how the implied earnings effect historically was low coming into this earnings season. And what that means is the implied moves then come down, which you'd expect after a bloody season. But what we're seeing is actually not very big moves again. And if it's possible, and we've only, like you said, there are only about a third or less that I've reported, and or less than that actually, and it's not looking good for them. It's still in the only 20% winners, which is it's normally 40% winners, meaning when you own a straddle, it moves more than the implied price. And so it's another bloody earnings season, even with the low implied earnings effects, Mark. So that's I couldn't believe it, but this is what we're seeing now. It seems like almost a paradigm shift in earnings, where it's not, just not moving the stocks as much as it used to.
Mr. Director of Risk, sir, I know this has been percolating on your radar as well. You probably have some questions for Mr. Matt, sir. What do you have up your sleeve?
Yeah, I was wondering, as far as the earnings are concerned, is there any difference or notice on companies who are giving their earnings before the election or after election? Are you seeing some type of election hump, depending upon the timing of earnings announcements with single stocks?
Yeah, so we break it down by earnings week, and it's a very good point we just made, is that actually the implied earnings of the ones before are much higher than the ones after. Usually you'll see the opposite. Usually you'll see implied moves lower for the early announcers, because those are usually the bigger companies that have the wherewithal to get their accounting earnings out quick. But yeah, good question. And no, it's actually kind of the opposite of what you'd think. So after the election, those implied moves are actually lower than we've seen for the first ones going in. That could be because we've seen such a bloodbath for the first 2 weeks, 2.5 weeks. But yeah, it's probably some election-related earnings, Chris.
Election-related tomfoolery. on the horizon. But I'm with you, Matt. I've been just surprised every season now, every cycle, at how little vol they're pricing into these names, A, B, and then how little vol they actually deliver. So they have to keep squeezing the vol, and yet every season it still underperforms. It is a surprising error. I think most people would have thought going into the start of this madness that maybe earnings would be maybe more impactful and certainly more volatile than they have been in the past, but yet we've seen no guidance, no real material disclosures from a lot of these massive firms. And you're right, it's not really impacting the stocks the way anyone probably would have assumed going into this. So earnings season, a bit of a weird beast. We've always cautioned you to be careful around times like this because it is, no matter how planned and prepared you are, there's still a bit of that element of chance to it. So we caution you to be aware, but if you are interested or you're looking to trade around there, maybe your clients are just coming to you with questions about it, we have the data for you. And you can go all the way back to the beginning of this year and even earlier. We have them going back for a while there on the site. So check them out if you are so inclined over there at theoptionsinsider.com. If you got questions about how they calculate it or what they're doing, head on over there to ORATSLAN, ORATS.com to learn more. And since we're talking about these types of event risks that are being priced into the market right now, like the election and like earnings, I think it makes sense to revisit an interesting topic right now and explore once again how you guys, on behalf of your clients, could hedge some of that very specific event risk.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the program where we revisit or review or analyze some basic options concept or strategy or technique or tip that you can utilize in your clients' portfolios. And again, because we are on the heels of so many specific risks and we are looming immediately on the precipice of a very major, I think what Matt has called in the past, the election effectively being an earnings event, an earnings risk, an earnings announcement for the market as a whole. By the way, if you are intrigued by all this and how it impacts the markets, make sure you join us live on election night, November 3rd. Here we'll be starting around 6 p.m. Central and going till whenever. I do believe Matt and Chris will be joining me as well as many others throughout the evening to break down all the things going on the financial side. We're not going to talk the political side so much. We'll leave that to the talking heads out there. But we'll talk about the impact of what we're seeing on the markets and, of course, on your portfolio. So if you're intrigued by that, you can join us live, of course, via the old Mixlers and everything else on November 3rd. And we'll, of course, try to cut it together for you guys after the fact on the network as well. Should be fun. Pencil us in if you're tired of all the crazy, contentious talking heads talking about this candidate or that candidate. Join us. We'll talk you off the ledge 1 week from today. But, of course, that just brings into more stark relief the notion of event risk. That's the kind of thing your clients are coming to you, and that's what they're paying you for. They're paying you to really isolate them and protect them from those particular types of events. You know, anyone could buy a handful of equities and watch them rally. That's not really where the skill set is for a lot of the asset managers and advisors out there. The skill set really comes in turbulent markets. That's where you kind of earn your dollars out there. So we're going to review a few very specific ways you guys can go on out there and, of course, hedge your clients' portfolios. If you want more details, of course, go back into our archives. We spent more time on all of these individual topics in the past. You can also check out programs like Options Bootcamp and Options Playbook Radio. On this network, they have a lot of detailed information about these as well. This is more of just a refresher or an overview out there. So there's a few ways right now that most of you probably will be considering hedging your client's specific event risk, whether it's the election coming up, whether it's an earnings announcement, maybe it's something else. Maybe it's another specific event you're looking to hedge. Either way, there's probably a few ways you're looking at doing that. The most basic, the most straightforward, of course, your old friend, the protective put. Let's go through a basic example. Remember, everyone's made and lost fortunes in XYZ. Hopefully we'll all make some money today here on XYZ. Let's say in our example is trading for $100. You go out and you say, you know what, I'm worried about this election. XYZ could be an index in our case, and your clients are loaded up in it. So you say, you know what, I'm worried about the election. I only want to go out about a month. Remember, that's key. Only buy as much protection as you need or you think is warranted out there. You can certainly pay for a ton, but if you don't need all of that, then you're kind of just wasting your money. So in this example, we go out to 1 month. That's all we're worried about, just through the election. And we're going to buy 5 handles out of the money. We want pretty tight protection because we're kind of worried about a little bit of the bottom falling out here. And in our example, because we like to keep things nice and even, that put cost you $1. So what have you done now in our example? Well, you've effectively stopped yourself out at $94. Remember, it's $95 is the strike. That's where you can sell that stock at any time. And you paid $1 for the privilege. So that adds on to your break even. So it puts you down at $94. Now, the pro of that is you're done. You've paid your $1. You're okay with that. 1% of your underlying cost in this case. That could be a hefty outlay if you're worried about that. But now, no matter what happens, if there's a huge sell-off, the drop, you don't have to worry about your stop getting triggered and maybe blowing through it in the overnight and then not having a chance to sell it at that level. None of that. You are stopped out at 95, and your effective price to get rid of the stock, I should say, is 94. So that's something you don't have to worry about. The con, it's obvious. It's pricey. It's 1% of your underlying right now. And we crunched some numbers because that little bit of juice is getting even more pricey out there right now. In fact, and certainly the recent sell-offs in the market hasn't helped this. Of course, that's the phenomenon we talk about all the time on the show called volatility skew. If you're not familiar with that, again, go check out some of our archives or some of those other shows I mentioned earlier. We crunched the numbers right before the show, just looking at the E-mini over there. So the S&P 500 E-mini, and that, of course, will translate to SPY and to SPX as well. They're all going to be in a similar ballpark. So coming into the show, we had just going out a few days. So the election's a week from now. So going out 9 days, the weekly puts in the E-mini S&P 500. So you had an at-the-money vol of about 32.5. That's already pretty juicy, as Chris was alluding to earlier at the top of the show. The puts, the 25 delta puts that you probably would look at to hedge, were trading at a 15% premium to that already hefty 32.5%. So you're paying a lot to hedge that downside. If you go a little bit farther out, let's say you go almost 2 weeks, you go about 11 days. That was the next weekly they had up there. That vol was about 34%. And those puts were trading even higher at a 17.5% premium to that already inflated 34%. And that's up from 15% just a week ago. So we've seen the skew in these names ticking up and getting more expensive. So if you're going to hedge right now, just be aware of that. You're going in, you're pretty much buying it when the house is not quite on fire, but getting pretty close to it. They're pricing in that house burning down pretty soon. So be aware of that. Before I keep rolling on with these examples, let's go back to the director of risk. Mr. Director of Risk, you're in this environment right now. Let's say you're an asset manager, an advisor, and you're looking to hedge. Let's say the election coming up or maybe some other specific event. Which of these strategies is kind of your go-to, and what tips or tricks do you want to share with our audience about them, sir?
Yeah, so all these strategies, all hedges have their day in the sun. I've said that before. So it really is, what is your thesis? What is your risk reward tolerance, if you will? More specifically with what is going on right now, like you said, and we're all talking about it, is that short-term volatility is very rich. So if you do want outright puts for whatever reason, maybe the shorter-term space isn't the appropriate space. Maybe we need to go longer-term where volatility is not as sensitive to short-term movement. So further out, like 1 year or 2 years out. Now, that being said, if you are interested in shorter-term hedges, you have to look to, well, how am I you want convexity, right? But there's a price to pay for that convexity right now. So you need to offset that. And you can offset that through put spreads. Put spreads are very popular, especially if you've done some homework, whether it's technically or fundamentally using earnings or what have you, to where you can kind of see where you're protecting that zone and you're picking a price point essentially. And the other way is, well, if you're really looking for a larger sell-off, I like back spreads right now. So selling one option and then buying two options as Vega neutral as possible, or at least not taking on too much volatility risk, so that if there's a really, really large move to the downside, you can take advantage of that. And the other case is if you think that the top is in for 2020, well, there's plenty of with skew not so steep, and I'm talking about looking at puts that are 20% out of the money versus the at the money put. There are opportunities out there right now to sell some upside calls and then use those proceeds to fund downside puts.
I like it. Mr. Director of Risk hitting on all of my examples. Now, let me just run through some of these listeners in case you're a little bit confused. And then, of course, we'll get the sharp-dressed man himself here to weigh in on these as well. Chris alluded to put spreads, one way that you could maybe upgrade your put protection and maybe also limit and mitigate the cost of doing so. So let's go back to XYZ. Remember, we just bought the 95 strike put for $1. And then, as Chris alluded to, maybe you have only a very specific window you're concerned about and a little bit of specific near-term downside you're really concerned about. You're not concerned about, let's say, the election really driving us down to what Chris alluded to earlier, 2,800 or a similar level out there in XYZ, 75. Nothing. You think you're worried more about a drop down to about the 90 range or so. So if that's your case, if you're worried about a more limited downside move, then you could just turn around and buy a put spread instead of the put. So in our example, we're worried about a drop down to close to 90, somewhere in that range. So we decide to buy the 95 strike put for $1 and then turn around and sell the 90 strike put, in this case, for 50 cents. So what does that do? Well, obviously, you've cut your outlay in half. So that means your protection going to cost you a lot less. The other flip side of that, of course, the downside, in this case, literally, is that your protection is limited to that 90 strike. If the worst comes to pass and you blow through that strike, now you're participating on all of that downside beyond the 90 strike again. So your protection is limited. It's attractive for the reduced outlay, and if that's what your analysis is telling you, then that's the way you should go. If you are worried about the aforementioned house burning down type scenario, then maybe a put spread, not the way to go. The other one, interesting one, we touched on this on the show recently. Chris just alluded to it as a back spread. You can also call it just the old ratio put spread. This is an intriguing one. This is kind of more of maybe an options 201 versus an options 101, but bear with me here, listeners, and we'll walk through it together. Same scenario, XYZ trading for 100. You obviously, in all these examples, by the way, I should mention, you own 100 shares of the underlying. That should probably be a given, but maybe if I didn't clarify that for you, I'll clarify it for you now. You own 100 shares at 100. What are you going to do going forward? So in this case, it's kind of interesting. If you're worried about it dropping, you can turn around and sell this 1 month 95 strike put. And so what does that do for you now for $1? Well, in this scenario, of course, you're going to collect that dollar. That might be good. That might be attractive for you. But then, as Chris mentioned, the ratio portion kicks in. You're actually more worried about perhaps a little bit of additional downside. So you turn around and buy now 2 of the 90 strike puts. Remember, those are trading for 50 cents in our example. So you sold one option for $1. You bought 2 more at 50 cents. Guess what? Those even out. So now you have effectively sold one 95 strike put, bought 2 of the 90 strike puts for 0 outlay. So what have you done? Well, first off, your outlay for your protection to the downside is 0. That's kind of nice. Having some protection to the downside is 0. But of course, your protection is a little bit different. Remember, you sold that 95 strike put. So in this case, if you own XYZ and it drops just down into that level between 90 and 95, you can pick yourself up some extra XYZ. So make sure you're okay with that, or you're going to take a bit of a loss on those short puts and have to roll it. So be aware of that. Make sure you understand the ramifications of that for your risk and for your portfolio. But if you're worried about that extreme downside move and you don't really want to have just buying the put, then you can turn around and now blowing through that 90 strike to the dark side. Remember, now you're short 1, but then you're long 2 again. So that starts picking up beyond that 90 strike. And so if it starts blowing through that 90 strike, drops down to, let's say, 80, you have that second put in your back pocket that you didn't pay for. That will kick in and give you a lot of protection there. So if you don't have the underlying, then it's just going to be a nice profitable thing for you. If you have the underlying, it's going to be a nice hedge for you that didn't cost you anything. So it's an attractive way to go. It's also a good way because one of the problems with puts is, of course, they have a long drag on their portfolio. If you can find a way to mitigate that drag in the near term and have it be set up for when that big explosive down move happens, this is one way to do that. So, Matt, we just outlined a few very specific ways that advisors can hedge specific event risk right now, particularly with the election looming or perhaps with earnings for their clients. What are your thoughts on these different examples we just broke down and maybe some others you'd like to throw into the fire there, sir?
Yeah, I think I could add a little bit to that. So in addition to convexity with Chris mentioned, there's also the vega. So what I like to do is go way, way out. I just type 555. And 555 days is about June 22nd, June of 2022. And, way out of the money, maybe 5-10 delta. And I just always have those on. And it's boring. It ends up only costing about on average 1% and up to 2 or 3% on the worst years. By the way, those worst years are when you're doing very well in your underlying. And the thing about these puts is, and puts in general that I think people should think about is, I have a permanent portfolio, which is gold, bonds, and stocks and cash. But, what we've seen in a lot of these downturns is everything goes down. People are selling gold to cover margin. And so everything's going down. The only thing that's not going down are puts. So, I had a decent time in COVID time because of that. The just being long those puts they are something that will just go up when everything's going down. You expect maybe gold to come back, but gold was down as well. Even Bitcoin was down. So they're just selling everything. One thing they can't sell is our puts. Even the VIX is chancy sometimes. So I always like to say, hey, listen, get these long-term puts. Have at least a few of them. You're not going to be sorry. I do something where I exit them, some of them after 300% gain. So you can monetize those and hold on to a certain percent. Now, if you want to get a little bit fancier, obviously there is that drag that you're talking about. What I like to do is a put ratio, which is a 1/2 for a credit. And the good thing about that strategy is you can make money grinding up, you can make money grinding down, and the only time you really lose is a very quick down move where the Vega explodes. And of course, those other puts that you're holding are going to do quite well at that time. I was lucky enough to seen the writing on the wall with COVID and such. So I got out of my ratios before. I only had the puts. So you could also do some timing on those ratios. And since you're getting a credit, you're helping offset some of that data. So those are the two things that I could add to the already good advice that you're giving, Chris, and you gave. Mark.
That's interesting, Matt, because I can see now why you and the director of risk get along so well. You have a similar thought process when it comes to long-term hedging. Now, I gave the caveat at the beginning of this that maybe only buy enough protection as you need, because this is, of course, focusing on a very specific event, like an earnings announcement or, in this case, an election. But the flip side of that is, of course, the unknown unknowns that are lurking out there, and that's maybe an interesting use case for, as Matt was just kind of putting it, put a few of those, maybe those stealth long-term puts in your portfolio for a rainy day. Chris, I know this is an approach you guys love out there, and in fact, it's kind of the foundation of the DRS, going out there, picking up these 2-year puts and then rolling them after about a year. So what are your thoughts about what Matt was just laying down there about these, shall we call them the stealth puts in your back pocket, sir?
Yeah, I mean, the longer-term puts, number one, it keeps you invested. So it's going to take out that timing risk. I mean, can you imagine all the people that sold who were not hedged during COVID, sold out of their equity portfolio only to get back in after the market had rallied 30, 40, 50%. So, having a hedged portfolio is going to decrease the risk of that happening, and it shouldn't happen if you have a hedged portfolio. Now, you can either hedge your entire portfolio on a 1-to-1 basis or notional amount, or you can kind of do, what Matt does is do the back spreads where you have a little bit more leeway where you can play with some units there. So again, the longer term as far as Vegas is concerned and volatility is going to be a lot more stable. It's going to keep you in the marketplace, and it just depends on whether you're really looking for a larger type bear market event where you can cover notional value, or do you want the flexibility of kind of timing the intermediate type moves, like we had this year with COVID and then this run up.
I'm going to get some of your questions here as well when we squeeze in a couple other very specific event risk type hedges. Chris alluded to earlier selling the covered call. That, of course, would be the collar position. Let's go through that. I've said many times on this show that is kind of the holy grail for advisors. It combines the two things they want most in life, protection and income. Of course, in this example, once again, you have XYZ. It is trading for $100. You own 100 shares of that bad boy. You want to, again, protect yourself. You're buying the 95 strike put for 1 month for $1. You just want to go hedge through the election. We're not going out multiple years, as we were just talking there. And now you turn around and say, maybe I don't mind also selling this thing if it goes up another, let's say 5%, up to like 105. So I'm going to turn around and sell also that 1 month call. In this case, you're going to get less for that. You're going to get about, let's say, 25 cents. Remember before we were talking about those other puts being like 50 cents or so. You're going to get a little bit less for the calls because, as we all know, equities, that call skew, the calls are going to trade at a lower implied volatility level than the puts. So now your net outlay, instead of being $1 for those puts, is down to 75 cents. So the pro of that is pretty obvious. You've reduced your net outlay. The con of that is not a lot. You haven't really given up a lot. But the other pro of that is you still get to play. You haven't just get rid of all your upside, you still have room to play, and you can get 5 points of appreciation to the upside. So that allows you to still have some of the positive upside potential, which is why you have XYZ to begin with. But of course, the downside again is that you're capped at 105. So make sure wherever you're selling that call is a level where you don't mind selling the stock. I know for some of you out there, your clients are restricted from a tax basis. They can't sell it. So this is a strategy. You certainly have to be judicious with where you choose to sell that strike on the call, and maybe may have to roll it if that's indeed the case, if you can't really sell it. Another quick bonus one really quickly, for those of you who have the tax wherewithal to be able to do this. Maybe your clients are saying, I'm kind of happy with the gains I've made since March, maybe the last couple of days, not so much, but that's a conversation for another day. Maybe they say, I don't really want to have all my risk on the table anymore. Another way you could go about this is to effectively liquidate the entire position. You're going to dump all of your XYZ at 100, but it doesn't mean you're out of the game. You could turn around and we talked before about speculating to the upside with calls. You could use straight up out of the money calls. Let's say maybe a 25 delta call for some upside, maybe a little bit meatier if you want a little bit more room to run. And now you can go in the money even if you want to spend a little bit more. That would be more of a straight up stock substitution play, and we have explored that on this network in the past. Go check out some of our archives for more detailed information on that. But either way, you can put a little bit of positive deltas back to work on behalf of your clients while the lion's share of their value, of their assets, is sitting safe and secure in cash. That's not going to go away. So now they can still play, still participate to the upside, but only have a very small percentage of their portfolio actually at risk. And that's kind of the magic of the leverage of options. So if you have clients that are very concerned, maybe this is an interesting way to go as well. A lot of ways you can go about this. These are just a few of the most common, some basic, some a little bit more advanced. Either way, you can use all of these techniques and a lot more to hedge either the election or whatever else you have on the radar and on the horizon that perhaps is concerning you and your clients. But now it's time to get to you guys. You guys deluge us with mail in between episodes. So without further ado, it's time to hang out the shingle and open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the Office Hours, a portion of the show where you guys take the reins, your questions, your comments, as we like to do in these troubled times. We kick it off with a little bit of love. This love comes from Anthony Papadopoulos, a.k.a. Tony P. It's a mouthful of a name there, Tony P. So thanks for the short version of it. He says, a short note to thank you for an amazing network with excellent educational content. I am listening to your programs and parsing the knowledge for several months and love to listen on my way to work and back. Thank you to your guests for their time and knowledge. Wishing you the best, and I'm sure I'll be writing with myriad options questions in the future. Sincerely, Tony P. Well, thank you for that. Tony P. and everyone else took the time to rate and review and leave such nice feedback on all of the various platforms out there. We appreciate you appreciating us. So you guys are really the reason that we do this. And we know it's more important than ever right now to keep the content spigot turned on to high for you guys. So we're endeavoring to do just that. All right, next up, Mr. D. I like that handle, Mr. D. Mr. D wants to know, this is for you, Mr. Matt. So put your sharp-dressed man question-answering pants on. He says, can Matt do an election move results report similar to what he generates for earnings announcements? It would be very interesting to compare earnings straddles versus resulting movement in recent years. Great show, and hats off to Matt for so much great data. It seems like, Matt, every time we do the show, you get at least one more fan here. Sounds like Mr. D is definitely in that category as well. But he has an interesting request here. I like his notion of taking what you guys do, that methodology for the earnings move reports, and applying it to what you yourself has termed an earnings event for the market, a.k.a. the election. So if so, what do you think of Mr. D's request, sir?
Thanks, Mr. D. We are people, too. We love to hear those great comments coming in. Yes, we do that. We started doing this back in September, and it's the same methodology as we do for an earnings event. We look at the expirations after the event. What are those volatilities? The expiration implied volatilities before the event, and usually the ones before the event are less than the ones after. So you then do a series of calculations, and what spits out is the implied move on that day, whether it be earnings or for this, the election. So what we found is back in September, the election move was 3.8%, meaning we thought the market would move either up or down 3.8%. About mid-September, 3.7, pretty similar. And then getting into October 1st, it was down to about 3%. 15 days later, mid-Oc, 2.5, and it's about 2.5 now. So interesting. The move has come down. Now, is that because the election is going to be contested? Is it because and then push the volatility back into the back months versus is the election going to be over and take the amount out? That's to be determined. But what it looks like is a little of both. But interesting how that earnings move has come down. This earnings move formula, the election move, has come down now, only 2.5% move, Mark.
We might need to add a new report to the arsenal there, the election move report. What do you think?
Yeah, the world needs more reports, Mark.
It does, especially right now with so much on the line. I think some folks might be intrigued. So Mr. D giving Matt some good homework, but hey, he's a fan, so we'll allow that. All right, next up, we've got a good request there, Mr. D. I like it. Next up, we have Illusion. Illusion wants to know, where does the panel fall on the utility of VIX options as an election hedge versus traditional 5% out-of-the-money puts in SPY or SPX? Which do you prefer in this environment? Do the new additions like VolQ and Spikes offer any new wrinkles to the environment? Well, a lot to unpack there. I will say from my own personal perspective, I won't speak for the director of risk or the sharp-dressed man here, but we didn't include VIX calls in our hedging of specific event risk. Maybe that should tell you a little bit of something there, Illusion. But still, it is an interesting topic. I know it's certainly a contentious one. Whenever you go to events like RMC and others, there are always a litany of papers and studies comparing and contrasting these exact same two topics over and over again. So it is a hotly contested issue. Let's go out to the Director of Risk first. Mr. Director of Risk, as Illusion wants to know, where do you fall on the utility of VIX options as an election hedge versus the traditional 5% out of the money puts in the index? And do you think the NASDAQ vol, aka VolQ, or Spikes, which is effectively a VIX on SPY, either of those add any new wrinkles to the environment, sir?
Yeah, this is a great question. It's almost, I'm probably going to put this question with the which came first, the chicken or the egg, because we're never really going to have the answer. And it really, the key here is, okay, what kind of environment are you in? And when I see that, when we're talking options, the first thing I think about is, well, supply and demand, right? I've said this many times. Supply and demand dictates where volatility is. So it really becomes, okay, well, it's not necessarily environment. It's well, what is happening to supply and demand and which one is cheaper versus the other one on a relative basis. So using any tool at your disposal to figure out, should I be buying SPX puts versus VIX calls can help. And one of the things I like to do is I like to look at the VVIX over the SDEX, which is the nation skew dex. So if that's elevated, if that ratio is very elevated, and this is just a quick and nasty number, it suggests that SPX puts are a little bit better than VIX calls, because sometimes it depends on the order flow, right? Again, supply and demand. Has there been a lot of reaching for VIX calls versus SPX puts? And you want to be on the opposite side of that, right? You want to try to maximize the probability with respect to volatility as to which hedging vehicle you're using for your portfolio.
Yeah, this is the contentious one. Matt, you're the keeper of all the data up there, as well as all the sharp-dressed clothes. What do you have to say for Mr. or Mrs. Illusion?
Some VIX options are good, and we've seen some weaknesses in the VIX using so many out of the money options. That's where the VolQ has some benefits over the VIX. Spikes has some benefits in the way they settle. Of course, I've already shown my hand. I like having puts. But I also, like dabbling in the VIX. We've already done a back test where the VIX puts were a little bit better than the VXX puts, and so I like to dabble in that, put land. But I'm a fan of just throwing on some long-term puts for hedging, and it'll be there. The VIX is good, and it gives you a lot of a curvature on some very quick and dramatic events. So a little bit of both, but mostly the puts for me, Mark.
Yeah, I have to admit I kind of fall on the put side as well. Just about every study I've ever seen on this issue, and I've seen a lot of them, kind of shows that in 95% of the scenarios, the SPY or SPX put is going to be your better and more reliable bet. That's exactly what you're getting. As I outlined in my example, you're stopping yourself out at a specific strike. You're costing X amount to do it. You have a delta. Everything is all baked in there. It's effectively a hedge. I kind of tread softly when I use the term hedge around VIX calls. They're much more of a speculative type tool, in my opinion. The reason I say that is because the few times that the VIX calls do outperform the SPY puts is when you start to have these explosions to the upside in volatility. If you have a long enough time horizon, where let's say earlier this year, covering through March, in that period where VIX exploded north of 80, the VIX calls are going to outperform in that very limited scenario. So the question is your time frame long enough to capture one or two of those moves? If the answer is yes, then maybe that move will be enough to offset the SPY puts. But in the other 95% of scenarios, you know exactly what you're getting and how much you're paying for with the SPY puts. And it's a much more predictable and precise hedge, which I like. The VIX calls, not as precise. You need that explosion. As Chris also alluded to, the utility of them also depends on where you are in volatility when you put them on. Buying VIX calls when VIX is at a 50 is a different beast than when VIX is at a 15. You have a little bit more room to the upside in one scenario versus another. So there's a lot of other moving parts to be analyzed in that equation. That's why, in general, I like to come down on the SPY or whatever index you're looking at puts versus VIX. VIX calls, I think of them as more as a kicker than I do as a hedge. In those crazy scenarios, having a few VIX calls means you're going to outperform. But outside of those crazy scenarios, much more reliable to have the S&P puts. But this is a topic we could debate endlessly for hours here on the old program. Unfortunately, that music means we've come to the end. It's amazing how quickly an hour flies by when we're talking election premium and hedging specific event risk and everything else we squeeze into. We didn't even get to half of the other headlines and everything else that's going on in the world of options and advice. This show needs to be about 3 hours, really, and we could do it daily, but we'll spare you that. Instead, we'll come at you for our one allotted hour. But before we go, let's go back around the horn. Let's start with you, Mr. Matt. If folks are intrigued, they want to reach out to you maybe about the election move report or about any of this earnings data, or maybe they want to talk about a specific back test of a specific strategy, where should they go? What should they do, sir?
Yeah, come on over to orats.com, Matt at ORATS. So we've been doing more consulting work than we've done in a while, where we run a bunch of back tests and help people figure out some ways to manage positions. We also have some exciting smooth market volatilities, calculating everything, all the Greeks and theoretical values in near real time. So we're excited about what's going on at ORATS. So come on over, orats.com, Mark.
Smooth market. I don't know what that even is anymore, so we haven't seen one of those in quite some time. Head on over to orats.com, O-R-A-T-S. They have all that great data we've touched on the show and a whole heck of a lot more. Hit them up. Maybe you could see what they have in store for you. And, of course, maybe you want to talk about some of these long-term puts that I know the director of risk is a fan of, or maybe some of these other approaches he's seeing out there in the markets and how they're pricing volatility. Maybe you're an advisor, you just want a little bit more education, a little bit more content in between episodes of this show. If that is the case, Mr. Director of Risk, where should they go? What should they do, sir?
Well, we got a couple of timely pieces right now, investing through market and political uncertainty, and historic volatility, election uncertainty, and the Fed's dilemma. So they both kind of focus on finding investment solutions like the defined risk strategy to keep investors invested and calm during periods of volatility. And you can check those two pieces out at swanglobalinvestments.com and all the other great content that we have on our website.
There you go. SwanGlobalInvestments.com is the place to go for
the newsletter, all the articles and white papers Chris just mentioned, as well as, of course, links to a fun show you may be interested in called The Advisor's Option. I dare say, what more could you ask for from an advisors-oriented outlet? You can certainly keep you engaged in between episodes of this program. On behalf of Mr. Matt and the Director of Risk, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. Keep them coming. We love to hear from you guys. And we'll see you back here next time, post-election, for another episode of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.